Look at the banking sector's ledger for 2025, and one number immediately demands attention: 87.2 billion pesos. That is the net income BDO Unibank posted for the year. While retail investors often react to market headlines with anxiety, institutional banking operates in a completely different environment: a cold, calculated reality built on risk algorithms and targeted capital deployment. We see this clearly in how BDO moved into the market. Instead of pulling back, they aggressively expanded their customer loans by 13%, pushing a massive 3.7 trillion pesos directly into the economy. Today, we are opening up BDO's 2025 financial report. We're going to pull apart the raw data behind this record-breaking year and extract the exact mechanics they use to scale a portfolio. What the numbers show is a highly specific formula. To command a market, you have to push capital out the door with calculated aggression, while maintaining an absolutely ruthless defense over the quality of those assets. The baseline for this performance is the previous year's 82 billion peso net income. Pushing past that figure required a precise top-line strategy. The engine driving this expansion is a metric called Return on Average Common Equity, or ROCE. BDO achieved a 14.4% ROCE for the period, measuring exactly how efficiently they generate profit from shareholder money. This chart maps the 14.4% trajectory across their total profit. To achieve this, BDO pushed customer loans to 3.7 trillion pesos. The vector line then splits. Net interest income surged by 9%, and non-interest income rose by an identical 9%. They even added a 10% increase in income from insurance operations, layering another distinct vertical onto their earnings sheet. A banking institution doesn't hit a record 87.2 billion pesos by simply sitting back and passively riding favorable interest rates. They force growth by scaling every vertical within their business framework at the exact same time. But pushing trillions of pesos into the market is mathematically fatal if you cannot control who pays it back. Aggressive lending requires absolute asset quality management. This graph reveals a massive anomaly in BDO's data. Usually, when lending volume spikes, defaults follow. Here, as the total loan volume line goes aggressively up, the non-performing loan ratio drops to a 1.68% baseline. For loans that do fail, the remaining bad debt is smothered by a 133% coverage ratio, absorbing every loss. Total deposits grew by 10%, with 68. When you combine a massive expansion in borrowing with a simultaneous drop in default rates, the data points to a highly functional Philippine credit cycle. Consumers and businesses are absorbing the capital, actively putting it to work, and consistently paying it back. BDO didn't let this record liquidity sit idle on the balance sheet. They immediately put it to work to build the next cycle of growth. In July of 2025, they went back to the market, issuing their fourth peso-denominated Asian Sustainability Bond. The issuance pulled in a record 115 billion pesos. This move diversified their funding architecture, allowing them to support even more lending without over-relying on standard deposits. For the individual investor, the takeaway is clear. Screen your portfolio for assets that demonstrate consistently expanding book values. This scatterplot measures book value growth against capital security. BDO sits firmly in the optimal upper right quadrant, showing an 11% increase in book value to 119 pesos and 3 centavos per share, backed by a robust 13.8% CET1 ratio. True market dominance requires aligning your capital with institutions that maintain impenetrable balance sheets while actively expanding their footprint. Emotion bankrupts portfolios. Clinical, verifiable data scales them. By adopting a strictly mathematical approach to the assets you hold, you stop reacting to the market and start commanding it.